Good morning, Carole. For our viewers, I'm here with Carole Barnay of ARDIAN. She is a Senior Managing Director of the Co-Investment Funds, and we're here to talk about the general topic of co-investments. But before we do, Carole, maybe you want to introduce yourself and your firm in a little bit more detail?
Yes, absolutely, with pleasure. So, as you said, I'm part of the co-investment team within ARDIAN, which is one of the many different investment strategies that we have within ARDIAN. The co-investment practice is a long-standing practice within ARDIAN because we have launched the first fund in 2005. I was there, so I'm doing co-investment since a long time. And today we are investing a $3 billion fund spread between Europe and the US, thanks to also the fund of fund platform that is a $80 billion platform within ARDIAN that feeds our deal flow.
So Carole, what are the risks associated with co-investments? And what are the consequences of the current market situation, which has been described by some as difficult?
When you speak about risk for co-investment, you have to really distinguish two types of co-investments. On one side, the co-investments that are done by the LPs, by themselves, on case-by-case basis, and the co-investments that are done by a dedicated co-investment team, an experienced team that will build a portfolio that will be balanced and diversified, which is much less risky. So now when speaking about co-investment strategy or risk, the inherent and structural risk is the fact that you are a non-controlling shareholder, and so you will have less visibility into the company, and you will also have less room of maneuver if things go wrong. So it means that the decision to go or no go will be very critical and demanding in terms of expertise and experience. So that, and you will also have to put an additional layer of due diligence above all the due diligence that you usually do as direct investment fund, which will be the due diligence on the sponsor, the GP itself. That being said, in the current environment, I see two major risks for co-investor. The one that is obvious is the price. So there are many companies today that are still sold at too expensive price that are not reflecting their fair value creation potential. This is like what happened during the global financial crisis, and it takes time to correct the valuations. It's not as quick as in the listed market. Then on the deal flow, I really see a risk implied by the fact that now the deal flow is a breakdown between a few number of high quality assets, and I can revert back on this, and a large mix of poor and median assets that delivered returns over the past few years, but that are dealing now with recession and inflation, and that won't deliver the same returns even if paid at fair price.
Does the co-investment strategy make sense in these challenging market conditions, Carole?
Yes, I would say absolutely, and even more. Why? Because when you decide to go with a co-investment fund, it's actually because you want less risk and strong returns, and it's the best options compared to buyout fund. Why? Because a co-investment fund is targeting diversification that will naturally provide you with lower risk, while in parallel we're still targeting buyout deals that will deliver buyout returns with lower fees, in the sense that we don't pay fee and carried to the GPs with who we invest alongside. So the net and gross difference in terms of return will be lower, so that our LPs will have a higher net return. And so if you ask me what makes the co-investment strategy attractive today, what I see is that actually when you go with a dedicated investment team, today we have a much more significant deal flow because a lot of LPs have stopped co-investing. So our total addressable market is larger. it means that we can even raise our selectivity ratio, and we have more choice to pick the best opportunities. While in parallel we can build a strong relationship with GPs or even build new relationships in this environment where there is less co-investors.
And do you think investors need to change their investment strategies in these market conditions?
I would say they don't need to change, but they need to be even more cautious. So the way to do it is quite simple. You need deal flow quantity and you need deal flow quality. Quantity, you need a large base of GPs to be sure that you will be able to look at many opportunities. So taking the example of ARDIAN co-investment fund, every year we look at 300 opportunities and our selectivity ratio today is 3%. So we do 9 deals out of 300 opportunities revised. This is one point, but quantity is not enough. You need quality. And so for this you need that your GP base is top quartile GP base, so that you will have good quality opportunities and also diversified opportunities. So your GP base will need to be diversified in terms of sector, in terms of geography, in terms of company size. If you have this, then you're okay. And the last point that is very important is the due diligence you do on the companies and the fact that you have to be stringent on the criteria you need to match to go with the deal. So the business has to play in a market that is recession-proof, and you need to be exposed to non-discretionary consumer spending companies. You need to have business models that are recurring in terms of revenue with a customer sticky base. You need to go with leading companies that have strong management teams. Otherwise, you can go with small companies, but then they will need to disrupt their market and be very agile and fast growing. If you don't have all those criteria matched, then you should not do the deal.
So my next question is, what is the best way to manage the LP-GP relationship in these challenging times where there might be more tension?
Yes, I think this is really today a good timing to narrow your discussion with your GPs and share your views and explain really why you think an opportunity is not matching your quality criteria, because they really need to hear from their LPs, and then it's a good sign for you to judge about, are they smart enough to adapt their investment strategy today? Are they cautious enough based on what you consider they should do? And so it's really the opportunity to get closer to your GP and think more in a partnership way of dealing.
Talking about close, do you think it's better to be really close, or do you think it's better to be more hands-off for a relationship?
Yeah, so if you are an LP that does the co-investments by yourself, you have to be cautious. So probably you should really slow down your co-investment deployment pace. Inversely, if you are a dedicated co-investment platform, it's really the opportunity not to do more deals, but to continue to be very selective and get closer to your GP. So try to partner in consortium and be really proactive in sourcing the deals.
And what can, in these times, the parties do to keep the relationship friendly, to keep the trust?
Yeah, it's always the same key success factor for the co-investors. It's to be extremely efficient and agile in the way you digest the materials, and in the way you are smart in your question, and in the way you are quick to be able to commit yourself before the binding offer. So it's a 3-week, very intense period of work. If you do this, then your GP will really value your contribution. I think that's the main point.
And more communications means more trust?
Communication is always key, and transparency in the vision and in the position that we can take that are not always the same as the GPs. Sharing our own experience in the same industry on peers, comparable companies, is really rich in terms of intelligence sharing So that makes part of the quality of the relationship.
Carole, thank you very much for these very insightful points.
Thank you very much. Have a good day.